There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Well, my name is Steve Federal. I am the, hopefully, Auvoria Prime CMA, trying to be your risk manager. Today is the 15th of October. Beginning first 15 days of Q4 are in the books. It was a crazy one on Thursday and Friday. We'll go over that, especially in equity land. So, what is going on? If you take a look at the screen, you'll see the forexfactory.com. I still think it is the best place. After more than a decade, I've been using this. It's fairly accurate. It's on time. Yes, we are looking at the previous week. And I want everybody to see this. If you're not paying attention to the screen, I highly suggest you do. What do you see? You see the consumer price index, both the core and stripped out month over month, year over year, coming in hot. Okay. So this is going to be since I'm trying to figure out the name of my next blog. I have a name I like. I just think it's too long, but it's called A Walk Down a Dangerous Fed-Induced Memory Lane. And it just talks a lot about, I'm not going to get into it. I'll give you guys a link to it on when I finish it. I don't write a lot of blogs anymore. It's a big precursor to winning lots of awards. I used to write. You're supposed to be out there in the media a lot, writing and speaking and all that stuff, and I just don't have the time for that anymore, or the inclination. So, but when I do write a blog, it's typically about some big macro subject that I feel has been completely unviewed, blown out of proportion, and typically unexplained in detail. So the walk down Fed-induced memory lane essentially just breaks down the Fed was paying attention to too much wrong and relatively recent stuff, looking essentially in the rearview mirror while trying to drive the car of monetary policy forward, right? You probably heard that analogy. And it was incorrect because they blew rates way up and they weren't paying attention to some of the other undercover factors, and it created a lot of problems that had to be straightened out in the mid-'80s from a lot of inflation in the 70s. So what are we going to do this time? Well, we know if you've just climbed out of a long hibernation from a log, I'd say welcome to the world. We are in the midst of some pretty hot inflation, and we're seeing it in most developed markets. I think the stimulation from many markets, I should say many governments, the stim from pandemic problems and all kinds of lax monetary and or poor decisions / supply chain disruptions with increasing demand based upon all those factors has created an inflationary market. The only way to kill inflation is to kill purchasing power, or to crush it with high costs for purchasing. Isn't necessarily 100% done via raising interest rates, right? Certainly makes credit, loans, the cost of doing almost everything much, much higher, including all the leverage that is put out there in this system from many different types of entities, right? So it'd be market-based entities of leverage, or certainly real estate. I don't care if it's, residential, commercial, industrial type of development. It certainly comes with a certain amount of leverage. Those forces, depending on the area, are probably going to cease. So I don't think there's going to be anywhere near the kind of new projects coming out, even though I guess in certain parts there's still a higher demand for housing in the U.S. This is probably not stuff those that have tuned into my podcast are hearing that's any different. But I think that we, as I don't know, let's just say educators as a whole, we have spent way, way more time inside the nitty gritty of what's going wrong than figuring out what's going right. Right. So if you recall about a few months ago, talking about how changing goals slightly from just, I gave the example of trying to get down a river and you're in, a boat or canoe or some sort of craft in the water. And instead of focusing on getting to the end of your trip, focus on the things that could disrupt your trip and put a lot of attention to what's called anti-goals, right? Like hitting a rock or not being able to paddle correctly or your life vest not working or you drowning or whatever. And you have a much, much better chance of getting to that goal if you focus on the stuff along the way, right? So if we apply that, I'm not sure the Fed is working on anti-goals at this point. I think they are working mostly on just the goal of squashing purchasing. So if we can effectively do that, and there's many, many different ways to do that. I don't have the time on this call. It could be hours to explain that. I'm getting into a very, very deep, but I hope that my blog, which is almost ready to release, will actually break that down. So I'll post a link to it. It explains it. Essentially, I think that, we have to cut down inflationary costs because the end result of much of this, if you overshoot, so to speak, is that you absolutely kill the economy, right? And then everything goes down. So for those not understanding why, S&P and NASDAQ are both off close to 20 and 25 and 30% respectively, now understand that there. So that's last week. This is this week coming up. Anything that's CPI, this is what's important, right? This is a bananas forecast right here, I must say. They have it worse in parts of Europe, much more so than the U.S., much higher inflation. Been some very bad decisions made recently that are putting some pensions and a lot of sovereign-based, or I should say large funds, period, for public employees in jeopardy with some of these bad decisions that were made by a whole host of actors and actresses. It's not necessarily one person. Blame always seems to get shifted to the fall guy. In many of these cases, they need a person to take the fall for it. But this is just these are just a group of just poor decisions made by many people that have never ever run monetary systems before. So, but in any case, these are the news for next week. Stay away from anything red folder, in my opinion. If you're trading the Canadian, Australian, certainly the NZD, those along with the GBP numbers are coming out next week. So we're looking at daily charts here. It's finviz.com. I think it's a great website. Just for a quick glaze through, if you will, it is a wonderful place to see a dashboard of correlation and uncorrelations. And the correlation really has been everything in stock land down. with the exception of a couple of companies, really rare, right? And then everything going up depending on currency land in the dollar perspective, and then all other currencies for the most part going down. So in this case, just looking at, not going to go into too much detail on all this. You guys can kind of see this. Quite disheartening, though, I must say, when you're looking at the 10-year, and for that matter, that the pin action of the other U.S. Treasury bonds and notes, these prices keep falling. So this is a factor of inflation. These, especially the 10-year note, is where much of the 30-year fixed rate mortgages derive from. So if price is going down of this, the yield is going up in the 30-year. I don't care if it's a 30-year, 15-year mortgage, those rates have doubled from a year ago, right? So it makes the costs, as you've probably seen, some of the people I follow on Twitter, they've been dicing up, mortgage change costs 6 ways to Sunday. So the other sort of, maybe a pin action off of the Fed raising interest rates is that if you're killing demand, you're also forcing the hand, if you will, on those that have been jammed into a 6% mortgage, right? Maybe they'll say, a lot of people will find all kinds of ways to reason to themselves. I call it compartmentalizing out of a bad decision. But the costs of borrowing at double the mortgage rate are, it's dramatic if you're buying a $500,000 or $600,000 house, which is about where the median price is, right in the low fives, and the median price was $400,000. So we still have a long way to go in real estate corrections to get back to just even where we were a couple of years ago, let alone it's higher. So what does that do? if you talk to, I was in a neighborhood the other day talking to some people, and luckily a few of them hang on a second. A few of them had sold the house. Choking on myself here. It's ridiculous. A few have sold the house at the high. I mean, that's just, hey, cheers, hats off to you, right? But now they're renting. And some of these rental prices, they're paying a little bit higher. So some people are sort of up in arms about this. Look, I get it. Rental prices are higher, right? But it's a lot better than losing a couple $100,000 in the value of your house, right? As long as you don't rent too long. Anyway, so just looking at the credit markets here, let's go into currencies. Dollar has been very strong, pulled back beginning of October, took a big correction. No surprise, dropped almost $4 from 114 to 110, and now it's back up. As I had said, and quite easy to see if you're into technical analysis here, 110 is basically a nice solid little floor at this point, and that we could have a $4 balancing from high to low. And that's what we've seen since that point. I would expect the dollar to continue to balance unless there is some sort of force out there that has a break from that balance range of 4. And if that is in fact the case, it's going higher. So we had, as you can see, significant rejection at both 14 and 10. Now twice, these small candles to see, but off the top, and we're stuck in a range, right? That's about the best, unless you're short the yen and in love with your trades. That's about the best advice I could offer in terms of USD. Always pay attention to your levels. $1 on the euro, as you can see on this chart, that dollar range, that's the high. And then the low obviously is 96, as you can see on the chart. So not a lot of detail I'm throwing out there, not a lot of chart patterns, but I think that, it's important to understand that the best thing you could do during these periods of times, if you have, Obviously, trade in front of news, especially red folder based events. But outside of that, the best thing that anybody could do at this point is study up in your trading, right? Learn your markets better, learn your patterns better, read a technical analysis book. I mean, there's all those kinds of different ways that you can teach yourself about this business, right? As I always tell most of the trade currencies, there is a lot more to investing out there than currencies. Take a look at other types of markets, right? No, I'm not talking about leaving currencies to go to crypto, right? You're going from the sublime to the ridiculous at that point. I'm talking about just general diversification, other types of investments, right? It could be real estate, right? You can buy a piece of artwork. Maybe that'll appreciate for you. You can buy physical assets, right? If you listen to all the brainwashing physical gold buyers out there, they'll say that you want to own physical gold, right? If you are a prepper and you think it's doomsday coming up, you could certainly do that. I never really have seen anybody outside of an exceptionally wealthy person I have as a client, only because he can afford to have all those gold bars in his house. I've never really seen any decent logic behind having ridiculous amounts of physical gold, unless you are so rich and it doesn't matter, in which case none of the discussion I have matters much to you, because you usually have other people trading your stuff, right? Investing your money. But certainly can't hurt to hold about $10,000 or $20,000 of physical gold. Really can't. I believe in a couple of gold bars in the safe, right? The problem, most of these people just that accumulate a lot of this, let's say the world went to hell, right? And it was like the joke, it was a lawless society. A lot of people think this is coming around. These are usually the ones that have like 100 guns in their house and ammunition and storage rooms full of rice and all that stuff as preppers. Let's just say the world went to hell. What is a half-pound gold bar, which is worth a ton of money, going to help you, because you can't break it down into a smaller denomination, right? Well, Steve, okay, that's great. So I'll just buy smaller bars. Yep. You could buy a single ounce, right? Trading around $1,800 a share. Actually, how gold traded on Friday. Yeah, so 1650. And just remember, when you go to sell gold, you rarely get the spot price. Just remember that. You'll always get a price that is lower than that. So certainly if you're going to do something like that, and I'm talking about a normal market-based society, not, the end of the world and doomsday shit, you can, always sell your gold, but just hunt around for the best price. You will find there is a lot. If you're going to sell your gold, please stay away from the payday loan places and, in the dirtbag parts of town where all the degenerate gamblers hang out and all. Those are the places you want to stay away from, because they won't pay you crap for your gold, right? So here's my lesson on trying not to be a degenerate. You know what? I think enough of the broadness. Let's go into the detail. So for those trading equities, you would think, let me just put this in perspective here. You would think that on Thursday, it's the S&P 500, largest, most capitalized companies in the U.S., but most of them are global companies. You would think that the world has stopped being a bear market, right? I saw a lot of people were very surprised when we went down huge. And I can't represent the volume here like I should, but this is a pretty big vol day. So let me just reset this. This is the front month contract. So let me jump over to the actual S&P itself. So this was a big vol day. Here, you can see by the big volume here, we had a big reversal. Represented quite well. Now, Here we go. It's probably a better way to show it. I always like to just be clean as you're viewing it. But we came into 1, 2, arguably 3 days of one-time framing down. We had an indecision candle. Obviously, we were waiting for data. No surprise. A lot of people are just completely shaking their heads as to why we reversed. Now, all I'm going to tell you is when you have watershed events like Thursday was, right? You get down, you completely clear the queue of all buyers, right? Or I should say buyers and sellers in this case, because both got barbecued in this. As a matter of fact, an Artemis hedge fund announced after this they actually going to be closing down because I think a lot of their quant systems just went poop on this. But on this particular day, you had very bad news, right? Which really shouldn't have surprised as many players as it did. It was like a lot of people caught off guard on this one. So from a risk management discussion, the thing to learn is when big news breaks, one, you're not stepping in front of it, trading in front of the news. Two, you basically do the opposite of what you think is going to happen in a lot of these watershed events. So you're thinking, this is bad news. Fed's going to raise a lot more, than maybe 4% in total, right? Maybe it's 5%, and then all you have the crazies coming out. And, they took the market way down. I mean, we gapped way down. What this tells me is that, at least on Thursday, there were a lot of players that were unwilling to see this market break because it had every reason to do it on Thursday, like much lower. And they came in and bought en masse. Now, get out your conspiracy theory craziness or intellect. I'm going to let you do your own research on this, but essentially this started happening arguably a whole bunch of times in 2008 during the whole financial crisis, and argue probably sometimes in 2009 as well. There were many, many days where it was exceptionally difficult to understand why there was a whole pistol of buying that took place when the market should have been off 1,000 points, right? Or in the case of the S&P, a couple hundred points down. And so the theories came out, and I think they got Alan Greenspan and Ben Bernanke to admit it. These are past Fed governors, not necessarily Janet Yellen. I know she's kind of talked about it as well. But if you ever heard the term plunge protection team, okay, this is where, at least in the old days, there would be somebody inside the pits. This is the futures pits in Chicago, which is buying what they call the bigs. Be buying the big S&P contract in mass. I mean, huge. Like, you'd hear things. I don't know if you ever heard that tape reading of this stuff, like Goldman 1,000 on the buy, 1,000 on the buy, Goldman coming in, JP Morgan following, Credit Suisse 1,000 on the buy. All the stuff you'd hear from. That was a very famous floor feed. A lot of people paid money to. It's actually quite comical. You'd hear a guy basically like calling a football game. Right? He's like an announcer. I forget what his name was. And he was like a super pit trader, and he decided to open up this trading service where he just called it what's going on. But during some of these periods of time where you thought the world should have been melting down, somebody was in there buying. And I think that was the case on Thursday as well. I can't put my finger on it. Obviously no Fed governor's ever going to announce that, we were in there buying equities, right? And a lot of times they'll do it in the form of big futures contracts. They won't be buying the ES. They'll be buying the big S&Ps. So you can actually buy those in your futures trading accounts. Now, you don't have to just buy the mini S&Ps, the P mini. You can actually buy the big contract. And you can come out and buy blocks of 1,000 of them at a crack, and everything's not floor traded anymore. But, obviously you can see it in the electronic markets. It was huge blocks coming through down near the bottom, which essentially was 3,500. This is right now in the S&P. This is absolutely bottom floor resistance. But I could tell you this, as we saw on Friday, dead cat bounces will barbecue the shorts and then a reverse the next day. Doesn't mean that is textbook, but I'm just telling you guys, if you're trading anything in equity land or indexes based, or, obviously there's lots of stuff out there in the MT4 platform that'll trade indices. Always be aware of a watershed moment like this, because it's a teaching example, and the markets can just really just turn on a dime and just get you when you weren't thinking. Because most people were just saying, oh, well, these numbers are bad, and the Fed's probably spinning around their chairs right now. They thought they had at least taken a bite out of, at least for a quarter or two, right? Inflation. So maybe there's a pivot coming. As that term where the Fed's like, well, we're not going to raise any more rates. We're pivoting to a more QE stance. And the markets, the Fed's in their backstop of the market. And if in fact that is the case, right, and you're Sheila hedge fund manager, right, and you're sitting on a whole pile of cash, maybe it's sold out and got lucky and all that, what are you going to do? You catch wind of that, you're going to start buying, right? Hey, well, let's catch the bottom. Fed's going to pivot. It's just you selling yourself. The stories just aren't part of how professional management should take place, right? I'd be selling this whole time, right? Waiting for this complete rip to just fizzle out, which took place late Thursday on a huge fizzling. Actually, you know what? More detail than I probably should here, but this is such a great teaching example. If we take a look at the ES and we put on a 1 hour chart, set the scale here and then go full screen. Let's give you guys the entire. So this is the move from the standpoint of the futures market. This is the mini S&P contract. Exceptionally liquid and wicked active market. Okay, let me just say that. It's one of the most liquid in the world. There are millions and millions of contracts of this traded each day. And for that matter, it's a 24-hour period in each day, but it's 23 hours. So this is an actively traded contract. So you had the news hit, right? We went way down. Remember, these are hourly charts. So we're looking at essentially the morning. Bad news comes out, 8:30 hour, tick over, and it's a positive candle, right? Market opens up at 9:30, which is halfway through this candle. We're now in the 10. Actually, you know what? Drop down to a 30. This is a better understanding of this. There we go. All right, so 8:30, news comes out. It's wicked negative. Mark gaps down. Remember, we were trading higher, and then we just absolutely grooved, man, back down. 9 a.m. hour, getting ready for markets to open up, but there's already big vol coming in, as you can see here. So this is a very tradable bottom from the standpoint of the way for the market to open. But all of a sudden, they're like, yeah, they're buying this. This is that Fed pivot thing, right? So if you're a big institution, you're sitting on piles of cash, waiting to catch the bottom, right? Remember what I said, don't always catch the falling knife. Yes, you will not catch the bottom. You'd be buying in higher, but that's okay. There's less risk that it goes back down and touches the bottom again. Right? All I see is that if you look from a market profile standpoint, probably need to. If you look from an accumulative contracts and the aggregate in terms of where they are, this is the blue lines on the left. Look at that missing notch down there. So essentially this whole, and remember the futures aren't perfectly lined up because it's a front month contract with the actual S&P index. So pricing slightly off if you're confused by that ever. It's not any kind of mispricing. It's just they trade with a front month valuation, which is usually slightly higher than the actual underlying S&P. So well, with the contracts here, we traded down and went underneath this area. And we're, we also have a whole bunch of missing notches right in here. And we have absolute end of the world down here, right? This probably wasn't that much of a completed auction. And imagine if we looked over, which I haven't had a chance to do. So I was out of the office yesterday, but if we looked at that, I'd be willing to bet we'll see what's called a double print down there in the market profile chart, which just means it's a ledge, right? So oftenly in the markets, we'll go back down a one tick the ledge. I'll get a little deeper than I probably should here, but I want you guys just to understand kind of how this plays. I don't necessarily need a futures chart to see this, but I know for a fact there are a lot of people out there in Auvoria land that are trading the MT4 or the NAS, or trading, an S&P based, Forex MT4 stuff. So get ahead of myself here. When we get back down and we essentially one tick the bottom, we started going up, and then we got past, obviously markets were, gaining more steam, and then boom, all vol comes in. I mean, this is actually pretty big vol too. So let me see. Yeah, pretty big vol. So, we completely ripped, right? You're not going to step in front of this trade right here because the momentum is just a massive up day, right? You're going to wait for it to fizzle. And then you're going to wait for a print. Could be a spinning doji, could be a doji. These are each 30-minute candles. So this is where I would have probably taken a crack at a short. Ideally would have gone up one tick this missing area. Notice there's not like a complete volume auction up here. But the problem is it used to be a real pro to trade around this news. You got to really know what you're doing, because then we had a blow off top, and then it just continued throughout the day. This is 10 a.m. on Friday here, Eastern time. And then it was a slow grind back down. So you would say, well, why did we stop at 36.26? Take a look at the chart. What do you see? Where did most of the volume in the futures markets play out? Even if I really scrunch this up, even if I totally make these candles small, guess where the point of control is? See how it dropped a little bit? Watch where this red line goes to. See how it dropped? That's the point of control. So when the market was forming itself out, oftentimes the aggregate of the most volume that's traded is what's called a point of control, meaning that this is where most did their business executing, buy or sell. So oftentimes markets will come back to, if you also are just lining up fib numbers like I'll typically do on a pattern, this is a 50% retrace rate, we stopped. So as a trader coming in Sunday night to the opening of the markets, what are you thinking? If we get under this line, where are we going? My bet, back down test 3,500. That is my thoughts on the S&P. I don't show the Dow charts because I know there's some that trade the Dow 30. I don't like it. I won't trade it. It is 30 stocks. It is an inefficient benchmark. It has been around since 1929. I think it's a piece of crap. I tell clients to get away from it and focus mostly on something that is a broad-based index that has a heck of a lot more predictability to it and liquidity than the Dow. There's not a lot of Dow futures that are traded. It's mostly the Qs and the ES and a little bit of Russell as well, the RTY. So, but it's mostly the, I don't have the NQ futures on the screen. I don't know if you guys noticed that, but I just have the ES to illustrate a point in broad ES land. On my other systems, I have the NQ charts, and I actually do chart the YMs as well. So, all right. So, let's take a quick peek. So we're still holding firm here. Coinage. Real quickly just go through these currencies. Daily chart. So remember, we got market profile on the side. Remember, data that's being fed into TradingView is from FXCM markets. So each currency will have, in many cases, a different data feeder. So FXCM feeds most of the main data in here. But TVC brings it in for the US dollar index. So again, I've already given you guys a range there, but just going back to pound dollar, lowest I've ever seen this in my entire life, right? I should say as an adult. I would expect this range 15 to the bottom. And this is when the dollar's at 114, 1.03. I mean, it's crazy. I may actually be able to buy something in the UK for $1 to $1, $1 to $1. Isn't that crazy? And if you're a U.S. resident, you're buying stuff in Europe, as I just bought a bike from France, make sure they're doing the currency conversions correctly. Give them hell if they haven't. Tell them to dial up TradingView or FID and Fizz to see that their currency rates are off. So, new lows coming for the Australian dollar, by the way. Still stuck in a tight range there. These are daily charts now. Murderization, is that a word? Of the yen continues. Euro CAD. Let's see, this 1.38 area is it as far as the shooting star on the top. Euro GDP. It's crazy. You never thought you'd see that, huh? GDP CAD. Let's take a closer look. Better decisions and reversals of poor decisions have certainly played out much better. Let me jump back. Something tells me that we're just going to go back down and visit this again. Maybe it is that incomplete auction. Let's see if we got down here again. We spent some time trading sideways around this area. It'd be a dangerous call to make, but it's almost like this could be like a generational buying opportunity. But those that think that the UK is swirling in a drain and about to go down it, right? As if they haven't already, arguably, right? That would be a very bad trade, in my opinion. Hard to let it play out. Who knows? Maybe Putin will finally cave in and realize that he's not going to win this war, and everything will rocket back up, and inflation will come down in Europe all in a month. I'll be fixed in a month. Hey, I hope for we have a lot of AP subscribers in Europe, and hey, we feel for you guys. You guys are going through some crap, but hopefully this wakes everybody up into the absolutely ridiculously poor decisions that the EU is making on all fronts, especially in energy policy. Vote in new policymakers. Still perplexed by why gold is at this price. But if you are wanting to be a purchaser of physical gold, right? Now's your opportunity to, folks, because the price is way down from where it was just at the beginning of the year. We went up and tagged the highs. See that? Now it's on sale. It seemed to me that there's all kinds of manipulation going on in this market. Usually, if things are really bad, people are buying gold. It's just that simple, right? And they're just not doing it. Why? I don't know. There's a lot of sellers out there of it, and maybe they were just over levered at some point and they need to lighten up, and that's kept prices artificially low. I don't know. It's really just odd, though. Seemed to me, based upon what's going on, gold should be $2,100 a share. 2,100 an ounce. All right. Crypto, weekly perspective. Amazing how things just died out at this price. Usually with a risk-off situation. Somebody's going to step up and unload a bunch of this stuff. But it's almost like, this is just a behavioral thought. It's almost like everybody got together that owns any significant amount of crypto, got on a Zoom call, and they said, hey, if we let it go below 19 or 18, this stuff's going to go all the way back to like 10 to 7,000. Everybody's like, yeah. All right, nobody sell. All right, we're in agreement. So, because we really should be much lower than right now. Now, from a perspective of behavioral, forget about the charts. Yes, there's certainly support points. Yes, this was a launch point right here, way back in December of 20, right? Pandemic craziness. It's support. But you spend enough time here with no decent rally, one of those people in that Zoom call is going to crack. I can promise you. If that happens, it's going to be a watershed moment. Then maybe the selling's all finished, right? This is the kind of stuff you want to think about. Maybe that watershed moment takes place and selling's kind of finished. Doesn't mean you buy at that point, unless you got tons of money, right? Maybe you can put an intro toe in the water, right? Starting position. Just understand that, it could take years for this thing to get back up to these other points. If you're willing to hold, right? Don't be a hold on for dear lifer, but just be a hold guy because you bought really low when it's the ashes, when the smoldering was finished, right? You just don't want another forest fire, another inferno to kick back up from the burning embers, right? So that's why you let patterns play out. Maybe it plays out lower. Maybe this is it. We go back up to 40K. I don't know, I hold very little faith in the bullish story on this right now, other than everybody's just kind of like, you first. So I'll end it on that note since it is 11 a.m. My name is Steve Vetter. I wish everybody a great trading week. Thank you for listening to me drone on about the markets as I often do. But the key really is to any presentation or person you listen to. Remember, I'm not your guru. The key is to just take a couple of nuggets out of it. I don't care if you're sitting in an auditorium listening to a retired military commander talk about motivation, right? There's always something great you can get out of a presentation. The key is to just pull some nuggets out, take some notes, and you'll have a much, much more broader education on this in about 10 or 20 years. Have a great weekend.